We're seeing futures in the red this morning. We're seeing bank stocks continuing to decline this morning. And that follows this Credit Suisse deal that was really supposed to stabilize the global financial markets and ideally all the markets throughout the globe. Why are we seeing this reaction from the futures and from bank stocks this morning?
Look, I think that that the way that this deal came through doesn't sound like a commercial solution, and that is unnerving. I think that's unnerving investors, and I think the bigger question is quite frankly, 39% chance that they don't hike. That's actually quite large. And that has been increasing, which is to say that the markets are starting to think that the Fed probably shouldn't do anything. And if they do, then we are likely going to go into a recession that the equity markets are not priced for and would have to fall significantly further in order to accommodate that outlook.
Gene, what about you? I mean, again, we're seeing the Dow down at least 150 points the open at this early stage, but the other two indices also in the red, and then bank stocks down 2-3% this morning after a deal that was really supposed to stabilize things.
Yeah, Frank, thank you for having me on your show. Listen, the Credit Suisse news last night, it's mixed. Positive, we see some stability to the financial system a bit. We saw that, UBS did agree to pay a little bit more than they anticipated Saturday. And the great thing is that the Swiss National Bank agreed that, it's not a direct government intervention. The big negative, there's two negatives that are really weighing on the markets. And this is why futures sold off dramatically last night. First of all, UBS executives continue to come out and say Swiss regulators made us do this. And second of all, this is something we'll learn about and talk about all day today, the additional tier one bonds, the AT1s. Basically, these are being zeroed out, and these are supposed to be senior to equity. So if you think about the ramifications on the go-forward basis, this is a big $275 billion market. And these debts are going to be wiped out. What happens to other banks? Other banks who have been tapping this market. Remember, these investments offer higher yield for investors, higher expected return. They are risky, but who would have thought that they would be zeroed out relative to equities?
So, Gene, I want to stick with you just for a second. I mean, after everything that we've seen, I want to talk about the regional banks here in the United States right now. Just very quickly, in your mind, how investable are regional banks? Is the sector? Do you have one view on the sector, or do you have different views on individual stocks?
Yeah,
look, I think.
Sorry, Gina.
Was that Gene or Gina?
Gina, you just go ahead. Yeah, don't worry about it.
Okay.
Gina, please go ahead.
Okay. So I think that the sector right now is a challenge. One of the reasons is that it's going to be thrown out, baby with the bathwater, or bank water, if you want to put it that way. That they're all being treated equally, and the reason is because the regulatory leniency that has been highlighted, that was part of the SVB story, exists in a lot of these banks. In fact, if you look at the banking system in the United States, you have almost 700. I mean, there is a massive amount of hold to maturity Treasury and MBS securities that, if they had to be sold, would be sold at significant losses. And those losses are not being marked and are considered Tier 1 capital, right? And so if that is not going to make you feel really, really warm and fuzzy about keeping your deposits in any regional bank right now, and that is exactly the kind of fragility that you're talking about. So it's a hard sell.
Gene, I'm going to ask you a different question. We've got to get out of here very quickly. What do you think about the Fed decision later this week? Are you expecting a hike or no hike? And which way do you think the market's going to react?
Yeah, we got three things from the Fed this week. Number one, the Fed should not raise rates, but they're going to raise rates by 25 basis points. We do believe that they have to. If they don't raise by 25 basis points, people will be feared about. There's banking issues, maybe there's other data. The Fed is going to prioritize price stability over economic growth. But again, we want zero, we want no rate hikes. Number two, the Powell presser. Clearly, they're going to stress flexibility in Fed policy. And the dot plot, the key thing, the dot plot, it's going to be less hawkish. Clearly, the Fed has a lot of uncertainty, but the Fed will push through with that 25 basis point hike, because just 2 weeks ago, in congressional testimony, Powell was saying he was worried about inflation, and nothing has changed in terms of the economic data.